Saira, I'm going to start with you because there was so much activity in equities this week. What happened?
David, there was three key drivers for the market this week. First was the retail wreckage, which shocked investors on Wednesday because we saw demand destruction. Consumers are not willing to pay anything for goods anymore. And secondarily, we finally did see that shift in spending from goods to services, but it came with a healthy dose of inventory building up on the goods side. This is not good for retailers' business model. Second is manufacturing data. After a great payroll number in April, strong industrial production numbers, yesterday, the Philly Fed Manufacturing Index significantly misses numbers. There's cracks in the economy, but it's not all doom and gloom. Investor sentiment's very negative. Markets are down almost into bear market territory. Valuations are starting to look attractive. And down stock markets and some demand destruction could give the Fed the ammunition it needs to finally take its foot off the gas in terms of interest rate hikes, but we don't expect that till at least later this year after they see some more data.
So, Bob, Saira says maybe the Fed can take its foot off the gas on interest rate hikes. What did we see in the bond market? Because we had seen that really dramatic ramp up in the yield on the 10-year, and then it sort of plateaued the last couple of weeks.
Well, David, unlike the equity market, the bond market actually found solid footing this week. And it all started when Fed expectations of rate hikes settled at around 2.75% at year-end. I know that's 2% from where we are now, but earlier this month it was at 3%, and the concern was that it was headed north to 3.5% or higher. Once Fed rate hike expectations settled down, the Treasury market settled down. You said we're at 280. Last week we were at 320, and again, the concern was that we were headed to 350. It feels as though the market is getting very comfortable with the narrative that the path to a 3% Fed funds rate will be enough for now to slow down growth and inflationary pressures, or at least get the Fed to pause. Now, look, I'll admit, it wasn't a perfect bond market. Corporate credit still had a tough week. Thanks very much, equity market and Saira. It was the lousy earnings that Saira talked about. And we had high yield yielding now 8%. It started the month at 7%. But overall, good week for the bond market. If Fed rate hike expectations and the 10-year yield settle around where they are, that will ultimately create support for corporate credit, and that should spill over into other asset classes.
Bob, what are we seeing in the underlying economy, as it were? When you look at those retail sales numbers from Target and from Walmart and things, some people are saying this is different from just a rate hike concern. This is a concern about the strength of the consumer, that basically they are not buying as much, they can't buy as much.
Well, we're looking at it from a credit perspective, and what we're seeing is exactly what companies said they would see this year, that they were seeing higher input costs. They were going to pass some of that along. They were going to absorb some of that in their margins. We're seeing that. The top line at a lot of these retailers was actually still very strong. It was up there. And I think the other thing that gets lost in all of this is perhaps the consumer is shifting its spending patterns. It's shifting away from the retail, and it's doing more in travel and leisure.
I agree with Bob on the bond market. I think it is leading the way. When equities were starting to catch up today, we did close in much better territory where we were. We could see a bear market rally, and we did see short covering this week. But with the retailers, I'm less constructive because that inventory build in goods on their balance sheet is going to be an issue. I think consumers are saying we're not going to pay anything for goods going forward. There's going to be winners and losers in the retail sector. For example, Costco. This is a winner, though, going forward. They have a more resilient business model, lower price points, and they have that subscription business, which gives them stability. They can raise prices there to overcome inflation, and raising prices is going to be key for companies in order to preserve their margins going forward.
Look, I think for sure, Saira, that higher energy prices, higher gas at the pump, higher food prices are eating into consumer budgets. But we still have to look at very low unemployment. We've got wage gains going up at the fastest rate in decades. It feels, after a little consolidation in here, that perhaps the consumer will return to spending more broadly.
Well, but does that cut the other way to some extent, Bob? Because if it's really going up that fast, the Fed may need to go further in rate hikes.
Well, I think certainly that was the narrative last month, that there was no high that the Fed could reach that would be high enough. It feels like we're seeing some pause in housing. There's enough evidence that things might slow down with higher rates and perhaps the liquidity withdrawal, that 3% is a good target for now.
Saira, one of the concerns has been valuations when it comes to equities. It's been, some would say, fully valued. I guess that's the polite way to put it. Is that out of the market now?
not completely out of the market. Equities are mostly pricing in a soft landing and somewhat pricing in a mild recession. And if we were to hit a deeper recession hard landing, we've not priced that in yet. We could see equities go down another 10% in that scenario. That is not our base case, though. Valuations are about between the 5 and 10-year average at this point. So this is where you need to start looking for quality companies with strong balance sheets that are trading on sale. Another area we like actually are growth stocks, which are very unpopular right now, but they're significantly declined. There's a lot of great companies in there. For example, even in the FANG sector, Microsoft, they have a 1% dividend yield. Dividend growers tend to outperform in higher rate environments. Huge total addressable market, strong enterprise demand, strong cloud demand. We're looking for opportunities in companies such as those, given the declines year to date.
Bob, Saira raised it, recession. How do you see the likelihood of recession? I think most people I've talked to, not over the next 12 months, but you go out 24 months, it's different.
I think when you look at the next 12 months, in the U.S., you still have to get through the summer where there's a lot of pent-up demand for travel and leisure, and unemployment is still very low and wages are going up. I think when you start to get out 18 to 24 months, then you're looking at a lot of things. You're looking at where rates will be, the cumulative impact of rate hikes. We think they'll be about 3%. You're looking at the bite that inflation will have taken out of the economy. You'll have another year and a half of higher inflation than the consumer would like to see. You'll have a strong dollar. You're also going to see the liquidity withdrawal from the Fed. So 2 years out, our probability of recession goes up to 55%. It's still possible for the Fed to engineer a soft landing, but frankly, it looks very aspirational when you figure they have to battle the highest rate of inflation in 40 years and drain away the greatest amount of liquidity we've seen in the history of Earth.
We're still more optimistic, Bob. We're between a soft landing and perhaps at worst a mild recession. But the demand destruction that we're already seeing, cracks in the housing market, those together, plus the 20% or so decline in the stock market, we do think that that could be one of the reasons in a few months from now the Fed has said they're data dependent. They could start to lower the number of rate hikes that they're doing and help us avoid that worst case scenario of a recession.
So David, there you have it. 2 years out, a lot of people are saying it's a coin toss. Someone in the equity side sees the optimism, a bond guy sees the pessimism.
Yeah, but my question basically, Bob, is if in fact the Fed decides it's really getting troublesome, so I'm going to have to back off on the rate hikes, where are we with inflation? I mean, is there a danger here of getting off the antibiotics a little too early? We don't have the infection gone.
Well, I think we don't want to acknowledge that Chair Powell already told us that if it comes down to growth or inflation, their battle is against inflation, even if it means avoiding a recession is unavoidable.
So, Saira, if Bob's right, what does that say to equities?
I think, for equities, it definitely leads to more downside. In a recessionary environment, they have not priced it in. But that's also why we're looking for those companies that are less dependent on economic growth. That does lead us to growth stocks. They have some of the worst returns year to date. And then also fundamentally strong sectors. Energy is a sector we still like because of the fundamentals. Tight supply, demand should remain reasonably strong, and producers are being very disciplined. And then finally, dividend growers. If you look at history, companies that have strong balance sheets, cash flow, can continue to grow their dividends. They'll give you that portfolio protection within equities and should perform quite well while the Fed raises hikes and be defensive during a recession.